Hi, Mike Flores here on behalf of TradeProsper. In this video, we will talk about how to take advantage of market trends. The simplest way to define a market trend is to use a simple moving average. Let's take a look at the charts and let's go over this now. On this chart, you'll see the currency pair dollar Swiss. Now you'll notice three dotted lines. The first black dotted line is the 20-day simple moving average. The red dotted line is the 50-day simple moving average, and the pink dotted line is the 200-day simple moving average. So to define the short-term trend, you want to see price close and trade above the 20-day moving average. So we can see here that currently Swiss is above the 20-day moving average. So we would say that the short-term trend is upwards. Now notice here we did break below it, but we closed above it, so the trend is still intact to the upside. Same thing with the 50 and the 200-day moving average. As long as price closes above those lines, we will say that it is a long-term trend bullish when it closes above the 200-day, a medium-term bullish when it closes above the 50-day, and a short-term bullish when it closes above the 20-day. Let's take a look at another example. Here is the coffee futures. We can see that the price action is well above the 20-day, the 50-day, and 200-day moving average. Therefore, we would say this market is in a bullish trend. Now let's go over to bearish. Looking at the sterling dollar market, we can see the sterling dollar market is closing below the 20-day, 50-day, and 200-day moving averages. So we would say that all three trends, short-term, medium-term, and long-term, are bearish or down. Here goes another example showing a bearish trend using the moving averages on the Brent crude futures market. We can see we're below all three, well below all three, and we can say that this market is in a clear down trend. Now let's take a look at the third scenario. Here we can see that the market is below the black dotted line, the 20-day moving average, but above the 50-day moving average. So this is a sign of neutralness to me. I want to see the market either be strongly trending upwards or strongly trending downwards. And in this case, the market is stuck in between the 20-day and 50-day moving average. To me, that means that the market is neutral at the moment. That's how you indicate that price action. Another example of a neutral market is the cocoa market. We saw we had this big move up, then this big move down. You see we have this double bottom down here. But notice how the market's currently in between the 20-day, the 50-day, and the 200-day moving averages. So this is also a neutral market. If we break and close below this 200-day moving average, then we would say we're in a bearish market. So we would see what happens here. Right now, this is a neutral market. That's how we'll define it. Now, let's talk about using swing highs and swing lows to identify a trend. This is the chart of dollar Swiss. I've circled the swing highs and the swing lows, the two most recent on this chart. So you see we have higher highs, right? We have one swing high here and a higher one there. We have one swing low here and another swing low here. So we have higher highs and we have higher lows. Therefore, we would say this market is in an uptrend. Okay, here we have lean hogs. So you see here I've circled again the two latest swing highs and the two latest swing lows. So we have higher swing highs, one swing high here, a higher one here, one swing low here, another swing low here, but again, higher lows. So higher highs and higher lows, we have an uptrend. I connected them with lines so you can see that the price is projecting upwards. So we would say that lean hogs is also in an uptrend at the moment. Now let's move over to bearish trends. So we have lower swing highs. So here goes one swing high, the second swing high, and these are the two latest swing highs. And then two swing lows, the two latest swing lows. We have one here and a lower one here. So we have lower highs and lower lows. This market we would say is in a downtrend. Heating oil, we have the same thing. We look at the two latest swing highs and the two latest swing lows. So the two latest swing highs, we have one high here, the next high lower. One low here, the next low lower. So we have lower swing highs, we have lower swing lows. We would say that heating oil is in a downtrend. And lastly, let's move to a neutral market. This is where the highs and lows do not go in the same direction. So in this example, this is the Australian dollar. We have higher swing highs, right? The two latest higher swing highs. and the two latest swing lows going lower. So this is going higher, this is going lower. This would be a neutral market. Now we're looking at copper, and this is the same thing. If the swing highs and the swing lows are not going in the same direction, then we would say it's a neutral market. So here we have lower swing highs, the two most recent swing highs, one here, we got going down. The swing lows, we have the two most recent going up. So this is also a neutral market. Remember, in order for it to be a trend, they have to be either going higher, the swing highs have to be going higher, and the swing lows have to be going higher, or to be in a downtrend, they have to be going lower swing highs and lower swing lows. This is the opposite. We have lower swing highs and higher swing lows, so this is a neutral market. Those were two examples of how you can quickly use trend to identify your trading bias in the market. Remember what I said in the post, we want to trade in the direction of the trend with greater risk than against the trend. Now there are other ways you can define trend, but those are the two quickest and simplest ways that I've chosen to show you today. On behalf of TradeProsper, this is Mike Flores. Talk to you soon. Bye now.